details of the quantitative tightening are now, I think, in stone, and I think it'll really be. And I predicted these in January, but I think they'll stick to this, and that is this $95 billion cap. And so what that means is that they get every day they get proceeds from redemptions of their existing inventory, and up till June, they've reinvested those proceeds. Now each month, subject to this $60 billion cap on treasuries, and 35 on mortgages, making 95 in total, they will not reinvest up to $60 billion. And
so $60 billion will expire, right? Because they're letting T-bills run off and other notes. So that runs off, they expire, and typically they would be buying.
If 70 ran off in that month, but 60 was the cap, they'd still reinvest $10 billion.
Okay, that's a good point. Right, gotcha.
So they still
on
are
mortgages.
And mortgages are trickier. And mortgages are trickier because they politically regret, I think, some more than others, the amount of mortgages they have in their inventory, and also mechanically, these mortgages are not going to be prepaid anymore. With interest rates this high, no one can refinance the Treasury's mortgage, the Fed's mortgage portfolio, and they are 30-year, amortizing bonds, and so the prepayments the monthly proceeds just aren't large enough to take the mortgage.
So duration is lengthening
down
on the mortgage portfolio, right? So
right,
they're not going to have that.
And the cash flows just don't come off fast enough. So they're going to have to sell in the marketplace mortgages, and I think that's well understood.
Yeah,
but the point I'm making is I don't think they're going to change that. I don't think they're even if inflation picks up in September, which Mester's now pointing to the next time they're actually going to have a decision to make. At least today she said that. I don't think they're going to ever increase the speed of QT that beyond the 95 billion. It's possible, but I don't think they're going to pull that lever. And the reason why is just as QE was highly effective for inflating assets, QT is highly effective and we've seen it, in deflating asset prices. Just the front running has deflated asset prices. But the linkage back to the economy is, the goal is to reduce demand. And the linkage for QT and QE has always been the wealth effect, which is the people that are experiencing portfolio gains spend more, and the people who are experiencing portfolio losses consume less. It's weak. And the only reason why we ever use QE to bail out the economy in the last 10, 12 years is because interest rates were at zero and we didn't have any more levers. But it wasn't particularly effective until 2020 in generating inflation. In fact, inflation undershot for most of the first 10 years of, when QE started in 2008. So it's not a very strong mechanism to create inflation, and it's not a very strong mechanism to reduce inflation because of this weak linkage of the wealth effect. What really matters is and the Fed has repeatedly said this, is changing the borrowing and saving rate, increasing deposit interest, which will take there'll be a lag before the banks ever do this, but money funds will start that transmission mechanism quickly. Just keeping money in the bank is actually going to be more compelling than spending it, and that'll reduce demand. And that's just the short-term interest rate being hiked. Very effective. Mortgage rates have been impacted by the short-term interest rate going up a lot, which has made housing affordability lower. And so they really believe that to tame inflation, they're going to have to increase rates. And it's not about QT, though QT will do its job too. It just won't be as strong.
But running off mortgages will obviously raise rates in the mortgage market to a greater degree than in the general treasury market, right? So that should help too.
The mortgages should widen the mortgage basis between treasuries and mortgages, and that'll be passed on to the end mortgage user, the borrower.